If you're an aspiring investment banker, then you should know the difference in the terminologies that people often use very commonly. Okay, so many times people tend to say, I'm short the market, or I'm short on gold, or I'm short on equities. No one's going to be short on gold nowadays. I'm short on equities, or I'm short on bonds, etc. All right, that is not the way to define a sell transaction. So let's learn more about what is the difference between short selling and outright selling. I'm a learning partner, Sushila Hariharan. And if you're interested in a career in investment banking, trade life cycle, OTC derivatives, and hedge funds, do subscribe to my YouTube channel where we provide content-centric, research-focused videos on these topics. The first one, what is an outright sell? In a stock exchange environment, an sell transaction is a selling of the underlying asset, the settlement of which takes place in India on a T+1 basis. So the seller has to deliver the asset to the central clearing house within T+1. Okay? If it's a T only life cycle, trade life cycle, settlement cycle, then you have to settle it on the very same day. So the seller has to complete his counterparty obligations as a contractual requirement that they have to deliver the assets. On the other hand, so that is an outright sell. They have sold the underlying asset. The asset leaves the portfolio. Money comes in. Okay. On the other hand, a short selling is very much different. While the first leg of the transaction is the same, that you have sold the underlying asset, the second leg becomes very interesting. The entity that has sold, the trader who has sold the stock, does not own the stock. Okay, that is the exact meaning of the term short selling. It means that they do not own it. That's why they short it. They don't have it. If they don't have it, how will they ever manage to deliver the asset as a part of their contractual obligation to the counterparty within the settlement cycle of T+1? For that, they need to borrow the security and complete the settlement obligation. So both the seller and a short seller, outright seller and short seller, both have sold the underlying asset. The difference is, in an outright sale, the stock has gone out from the existing portfolio, whereas in a short sell, they don't even have it in their portfolio. So the trader has to borrow the security in order to complete the settlement cycle, in order to complete the stock exchange contractual obligations of delivering the asset before the settlement cycle ends. All right? So a short seller is exposed to two different types of risks. The first risk is the market risk. That is, the price has actually gone up after he has sold the stock. So when the price goes up, they have sold it at $100, the price has gone up to $110. Obviously, the short selling position initiated by the short seller is now a loss making one, and that means they have to be either squaring off the losses, and also, since they have borrowed the stock, they'll be paying interest charge to the lender of the stock. Therefore, a short selling is not an activity which is meant for the retail investor. It is meant for traders who have access to mechanisms wherein they can borrow the security from those who own it. So outright selling is selling and then getting back the security, whereas an short selling is when they are selling the security, they have to borrow the security from a custodian or from a depository participant. They have to deliver the security. That contract is fulfilled. The short selling position is not from the stock exchange point of view, it is from the trader's point of view. So the trader is exposed to both market risk as well as interest cost. if the prices go down as he had anticipated, that's why he initiated a short selling trade, right? Then it is perfectly normal for them to make money out of the trade, and the financing cost could also be comfortable for him. But on the other hand, if the financing cost is also high and the price is also going above, then the short seller unfortunately has not taken a right call. So the big difference between short selling and outright selling is the outright seller is not exposed to market risk because he has exited the stock from the portfolio, whereas a short seller is exposed not only to market risk but also to interest cost. So before going for an interview with an investment banking entity like Goldman Sachs, Morgan Stanley, Merrill Lynch, etc., be clear that you are clear about the way the terms are used. Thank you so much for watching this video.